Good afternoon, ladies and gentlemen. Welcome to the AIA Contract Documents webinar, Insurance and Bonds as Risk Management Tools for Construction Project Owners. Just a few administrative items before we get started. You should now be able to hear us and see the slides on your screen. My recommendation is it's always better to use the telephone to dial in because sometimes you may have audio issues with GoToWebinar if you use your computer. So best to dial in using your phone. In addition to that, I do have attendees all currently muted. If you have any questions, please use the chat feature on the right-hand side of your window. And time permitting at the end of the webinar, we will go through any questions and answer what we can. You will be receiving the recording of today's session, as well as the PowerPoint slides. You will receive that by the end of the week. This presentation is protected by U.S. and international copyright laws. And now I'm going to turn it over to our presenters. We'll start with Ken Cobley, Esquire. He'll be introducing himself and we'll get started. Ken?
Thanks, Hosty. Good afternoon, everyone. I'm Ken Cobley. I'm the Managing Director and Counsel for the AIA Contract Documents program here at the American Institute of Architects. I've been with the AIA about 13 years, and prior to coming here, I spent about 18 years in private practice in a couple of firms in Baltimore. During that time, I represented contractors, subcontractors, owners, suppliers, and design professionals in various matters associated with construction projects and construction litigation.
Thank you, Ken. Yeah, my name is Mike Bamba. I'm a director and counsel at with the AIA Contract Documents team. I've been with the AIA for 13 years, and we're going to be talking to you about insurance and bonds today. I was involved in the 2010 revision of all the AIA Bond Forms. Prior to my time at the AIA, I was in private practice, primarily in Washington, D.C., where I worked at a firm and where we represented design professionals in the construction world. So with that, those introductions, I'll turn it back over to Ken and we'll get into the program.
Thanks, Mike. So the first thing I want to cover is the intent of this program, what it is and what it isn't. This program is not intended to provide legal advice. Each business is different and each project is different. And our goal is to identify topics that owners might want to explore with their insurance advisors or legal counsel, and that they might want to review on a project-by-project basis. Secondarily, we hope that you will see how the AIA's insurance exhibit can help facilitate those types of discussions and serve as a useful means to review insurance and bonds on each project. Just a little bit about our guiding principles. So the American Institute of Architects has been publishing standard form agreements since 1888. So over that 131-year history, those documents have evolved from a 3- or 4-page contract between owners and contractors to now over 200 agreements that span multiple delivery models. But throughout that history, one of the key guiding principles has focused on risk, project risk, and the goal has been to place the burden of risk where it's best managed. And that's one, on the party in the best position to control it, or on a party that's in a best position to insure against the risk. And from the outset, AIA documents have had insurance provisions to help manage and offset risks. As a matter of fact, the original uniform contract between an owner and a contractor, published in 1888, required that the owner obtain property insurance in the name of the owner and the contractor to guard against loss due to fire and to cover work and materials incorporated in the building and materials that were otherwise on the premises. So you can see from the very beginning, placing risk on insurers and using insurance to cover risk associated with the contract have been very important. So let's talk a little bit first about the kinds of insurance that the owner itself might want to look at and get. So you can see from this slide, there's a wide variety of potential risks that could be faced on any given construction project. And this slide isn't intended to cover all of them, but to sort of give a smattering of the different kinds of risks that might befall a project and might be detrimental to an owner. You can see that some of the risks directly impact the owner and the well-being of the project. And some of the risks are related to third parties that might be impacted if an event occurs on the project. And many of them apply in different ways to both first party, the owner, and third party risks. So how can owners guard against the perils on any given construction project? Well, there are a number of ways, but we're going to talk about two big ones in this program. They can use insurance to manage and guard against risks, and they can use payment and performance bonds. Now, people often view insurance and bonds as the same thing. Perhaps that's because many of the big insurance companies also write bonds. They are, however, two distinct products that work in different ways. Payment and performance bonds stand behind and financially guarantee the obligations of the contractor to perform the work and to finish the project and to pay subs and suppliers. With bonds, the contractor has not really transferred any risk to the surety and remains liable to the surety for the costs the surety incurs in correcting the work or paying off subs and suppliers. And that liability is usually memorialized in an indemnity agreement between the contractor and the surety, including personal indemnities from key parties with the contractor. And it's the nature of this financial, business, and indemnity relationship that results in other potential benefits to the owner. And Mike is going to cover that in the latter part of the program. Insurance, on the other hand, transfers risk from the insured party to the insurance company without recourse. So the insurance company cannot come back against the insured for the costs it incurs in paying off claims under the insurance policy. So what kind of insurance should the owners look to get? Well, if nothing else, there are two that we think are must-haves. One is a general liability policy, and the other is property insurance, including builder's risk that's written on an all-risk policy basis. Commercial general liability insurance products protect the insured party or parties, and sometimes you have additional insureds on there, against third-party claims and liability for bodily injury or property damage arising out of the business operations of the insureds. So it is a third-party coverage. It protects the insured against claims from third parties. Property insurance protects the insured party or parties against losses or damage to their property. And builder's risk is a type of property insurance that generally covers loss or damage to the work, construction work, during the course of construction, including losses due to the negligence of the contractor, as well as things that people often refer to as acts of God. On an all-risk basis means that the builder's risk insurance covers all risks of physical loss or damage to the property unless expressly excluded. So what kinds of things do you want to consider when you're looking at builder's risk from the owner's perspective. First of all, we believe that the owners should definitely confirm that the builder's risk policy is going to cover the total value of the entire project on a replacement cost basis. That means it should be at least the initial contract sum and any subsequent modifications. The builder's risk policy should also stay in play and be maintained at least until substantial completion. And this, there's varying policies depending on the insurer. Some will allow it to stay in effect afterwards, but at the very least, if the builder's risk policy terminates at substantial completion, then the owner needs to get follow-on coverage that will continue on the project after substantial completion and until the expiration of the period for correction of the work. What you don't want is to hit substantial completion, occupy the building, do other things, and have the contractor there to do some corrective work or punch list and have a fire break out and destroy the building, and you no longer have that builder's risk policy in effect. And builder's risk, the policy should include the owner, contractors, subs, etc., as insured, and also mortgagees as loss payees in case of a disaster. So what's the rationale for this big property insurance policy? Well, it's pretty simple. On a project-by-project basis, the risk of a catastrophic event is pretty low. But when they happen, they are astronomically expensive. And individual parties, owners or contractors, are really probably not in a position to cover a catastrophic loss. Insurance companies, however, can spread that risk over thousands of projects. And so the premium they collect for builder's risk aggregates, and so they have the capital to pay for those kinds of losses. What if the owner is not constructing a new standalone building, but is remodeling or adding on to an existing structure? Then we believe the owner should carry property insurance that's going to cover everything that the project touches. And again, it should stay in place until the correction period is over, and it should be on a replacement cost basis. So in summarizing, what should builder's risk cover? It's going to cover direct physical loss or damage, and you can see some examples of what it is supposed to cover and what you'd like to see it covering for physical loss or damage, and also ensuing loss or resulting damage, and then you can see the causes listed under that category as well. So it should cover a lot of evils that might befall the project in any given situation. So we talked about builder's risk and or other property insurance, general property insurance, to make sure that you've got all of the work covered in case there's a fire or a flood. And if it's a renovation or an addition to a building, you want to make sure that the whole building is going to be protected against the damage and the loss. Well, there are certain things that builder's risk will cover or property insurance will cover, but there are a lot of other consequential type damages and losses that you might experience as a business if you have a fire or flood or some other problem that would otherwise be covered, that arises from an event that would be covered by builder's risk, but those losses are not part of the insurance umbrella, and therefore you won't get reimbursed for it. So this slide and the next slide just highlights some of those extensions that you should consider that would go on to or tie with the property insurance that will cover some of those consequential damages that might result from a catastrophic loss, the inability to use the building or project during the time of rebuilding. And particularly if, for example, you had an addition going on your existing headquarters building and fire damaged both the new work and parts of the existing work, such that you were unable to use or access parts of that work. So we've talked about commercial general liability and liability coverages. We've talked about builder's risk and property. We've talked about the property extension coverages for consequential damages. We want to also suggest that there are non-property coverages that you might want to consider for special types of risk. And one of those coverages that we actually call out in our documents in the exhibit, cybersecurity insurance. Now, as owners, you may think, really, how can a data breach or a cybersecurity breach really result in catastrophic damages or damages such that I would want to carry insurance? Well, think about all of the ways that information is stored and transmitted digitally now on a project from beginning to end. You know, building information models and project correspondence, and somebody probably is going to maintain a central repository for all of the contracts and all of the pay apps and all of the correspondence among the parties. And I would say to you, those of you that are familiar with the security breach at Target stores, where the financial information associated with thousands and thousands of Target customers was accessed through a hack. The hacker gained access to Target's data through stolen credentials from an HVAC contractor. And it's estimated that breach cost Target hundreds of millions of dollars. So we want to prompt you to consider cyber insurance depending on the nature of your business and who's accessing which systems where. Another type of insurance for consideration that just recently came up is terrorism insurance. Now, we didn't list this in our exhibit as a specific topic for consideration, but we do have a fill point for other. But we got a call recently here at the AIA from someone who was putting together a series of documents for a project for an owner. And the owner was absolutely insisting on terrorism insurance. Now, the project is located here in Washington, D.C. And I don't really have many more of the details other than it was a high-profile project in the district. But I think that's something that, as owners, you might consider depending on the nature of your project and where it's located. And so when we say other, think about this project in particular and what risks might be unique to this project and whether you should or can get in a particular type of insurance to cover that risk. Okay, so we've talked about owners' insurance coverages. let's talk a little bit about contractors insurance and some of the things that owners might be interested in making sure they have covered by their general contractor and or flowed down to the subs. Well, first and foremost, as the owner, you want to make sure that your contracts require the contractor to provide you with certificates of insurance to make sure that they actually have all of the coverages at the limits that you wanted for this project. And I say that because part of what we're going to do in this program is encourage you to think about various types of coverages that you may want on any particular project and the limits that you might need. Well, all of that is great, but if you don't have a contractual mechanism for A, requiring it, and B, ensuring that the contractor has actually gotten those coverages, then the discussion is somewhat limited in value. So the certificate should show the owner as an additional insured. We require that on CGL and excess. You can get additional insured coverages on it for a number of things. For some things you can't, like professional liability coverage. But where you can and where appropriate, you should ask that the owner be named as an additional insured. And also, you want to make sure that your contractor discloses any deductibles or self-insured retentions that may be applicable to any required insurance. You just need to know how the contractor has set up its insurance program. And if a contractor has really high limits, but has really high deductibles or self-insured retentions, then you're going to need to make sure that they have the financial wherewithal to meet those deductibles or retentions, because that's going to have to be met first before that nice policy comes into play. So what types of insurance should you require of the contractor, consider requiring of the contractor? Obviously, you want commercial general liability. Again, you want something to respond to potential third-party claims, people that might be injured or have property damaged as a result of the contractor's operations. Auto liability, so that, for vehicles that they use on the project, either owned or borrowed, rented. Now, for some of these, you should consider whether or not you want to allow them to achieve the required limits by combining their primary coverages with excess or umbrella liability insurance. Of course, though, you want to make sure that if you allow for that, the combined coverage results in the same or greater coverage than you would have gotten through individual policies. And this is sort of a nuance here, but it's important. If you allow for umbrella or excess coverage, you probably want to make sure that the excess policy does not require actual exhaustion. So there's a concept that deals with excess or umbrella policies, and essentially, generally speaking, those policies don't come into play. They override or are an umbrella to an underlying policy. They don't come into play until that underlying policy has been exhausted. Actual exhaustion means that the insurer on the underlying policy has to have paid out the policy limits. Functional exhaustion means the underlying insurer doesn't necessarily have to pay all of the underlying policy limits. It just means that someone has to have paid in the aggregate the total value of the underlying limits. And when does that become important? It becomes important when you have big underlying policies and you're trying to negotiate a reasonable settlement and you want to get to the excess policy. If you have to go through functional exhaustion, you may have an underlying carrier that's not willing to put the entire policy on the table. If you have functional exhaustion, you may have a party that says, look, I'm willing to pay the last X in order to get to the big umbrella policy. So just a consideration. Of course, you want the contractor to carry workers' comp and employer's liability. You want an insurer that's going to be licensed in the jurisdiction where the project is located, and you want the contractor to maintain whatever coverages you establish until the period for correction of the work expires, because your risk is going to go through the entire time that the contractor might be on the project. This is just a list of things that you want to look at in terms of the commercial general liability policy. You know, commercial general liability policies and other policies can look great when you read the first beginning part of it. It looks like it's broad coverage for just about anything. And it's great until sometimes you get to the exclusions and you realize that there are a number of scenarios where the policy might not come into play if you've got significant exclusions. Here we suggest some of the common exclusions that should be avoided because the exclusions either significantly diminish the actual scope of coverage or they defeat the purpose of laying off larger risks of loss through a broad insurance program on the project. So you can read these for yourself as well as this list. One of the things you want to consider for some of it is there work that would be affected by the exclusion? I'm just looking at item 9 here. If you don't have these types of exterior finishes on a project, then do you really care if the CGL has that exclusion? And I say that because in some circumstances, the contractor may come back to you and say, my insurance carrier absolutely requires this exclusion. Well, if you consider it and you think, well, there's really not much risk on my project associated with that, you might allow for that exclusion. However, if you have a project that includes a lot of earthwork or might result in subsidence or movement or one of the other potential exclusions, and your contractor comes back and says, no, my carrier requires this exclusion, then you might want to have a conversation with your contractor about finding alternate coverage. Now, we talked about auto insurance in that first list, so it should cover vehicles owned or used by the contractor on the project. Now let's talk about required maybe coverages or maybe required coverages. And these are the types of coverages that should probably be required if the work involves certain elements. So, for example, if the work involves hazards that arise from work on or near navigable waterways, including work associated with vessels and docks, then you probably want to require Jones Act and Longshore and Harbor Workers Compensation Insurance. If the project involves some sort of delegated design responsibility to the contractor, then you want to require some level of professional liability coverage to cover that delegated design work in case there's a problem with the design that the contractor has assumed responsibility for. And the others are pretty self-explanatory. Pollution coverage, if the contractor is going to be bringing pollutants onto the site, maritime for other work associated with waters, etc. But again, not necessarily required on all projects. If you're in the middle of a cornfield, you probably don't need Jones Act. But so it will depend on the nature of the project. That's why we say they're sometimes required coverages. And then what about really optional coverages, the kinds of stuff that may not pose a big risk on the project, or you really just want to have a conversation with the contractor about, and with your attorney and insurance counselor about, on a project-by-project basis, because you have to weigh out what the risk-reward ratio is depending on the premiums and the availability of the coverage. I will say that we are hearing more and more situations in which the contractor gets the builder's risk insurance. And we're hearing that it is often less expensive for the contractor to get the builder's risk coverage for the project. Again, the owner wants to make sure that they are going to be covered by that builder's risk policy. And the owner should also make sure that it has its own adequate other property insurance, if it's an addition or something else, for risk associated with damage to other than the work. But builder's risk is one that can shift pretty easily. Railroad protective for work within 50 feet of railroad property. If you've got asbestos abatement as part of the project, or you think there's a risk that you're going to run into asbestos, consider that. And the others are also, as their names suggest. So we've talked around it. I've mentioned it a couple times, but the AIA has gone to the development of insurance exhibits that tie into their owner, contractor, owner, CM agreements, okay? And we have an insurance exhibit in each of the major delivery models. Now, the design build delivery model was actually the first prototype for the insurance exhibit, and it is a little bit light on terms. We will make it more robust in 2024. However, the insurance exhibit for design bid build, CM as constructor, and CM as advisor are pretty robust documents, and they are going to prompt you to consider all of the things we discussed, and then they go into substantially more detail on some of the requirements. They're going to prompt the inclusion of limits and so on and so forth. They're very robust documents, just begun to cover sort of the very high level points that are addressed in more detail in those documents. But we do have insurance exhibits across each of the major delivery models. And the AIA includes other key insurance requirements in the general conditions documents. So it used to be that all major insurance requirements, as between the owner and the contractor, were found in the general conditions. We'll use the A201 as an example. But in the move to the exhibit, we took a lot of that text out. We did, however, leave some terms in the general conditions, including the obligation to purchase the insurance in accordance with the terms that the parties agree on in the exhibit or elsewhere in the contract documents. We have some pretty detailed requirements about notice and opportunity to cure and right to stop work when there's a cancellation of insurance or a pending lapse or a failure to obtain the insurance. There's also a fairly detailed set of terms and conditions dealing with the waiver of subrogation. I could spend probably 8 hours talking about the nuances around a waiver of subrogation. I won't. I'm just pointing out that that is a really key part of the risk management process, the value of insurance on a project, and the general conditions as we have them set out. One set of terms that we have in the general conditions that I think is of real interest to owners is the terms around settlement of an insured loss, and essentially giving the owner the authority to control how a loss is adjusted and settled with the insurance companies. Now, those provisions also place specific obligations on the owner in terms of disclosing what they intend to, how they intend to settle it, allowing the contractor to weigh in on it, and allowing the contractor to either agree or disagree. And if the contractor disagrees, the owner can still settle, but then we have a claims or dispute situation, and that's their remedy with respect to the owner's choices for how to settle. So why did we go to an exhibit? Well, insurance and insurance products are changing radically, expanding, particularly when it comes to insurance for construction projects and different types. And trying to capture it all in a standard document in terms and conditions and say this is going to apply across the board to every project just was not reasonable. And so the exhibit allowed us to create a long list of requirements and points of discussion, and it allows the owner and the contractor to develop project-specific insurance requirements. And I think you could draw the gist of that from comments I made earlier. Also, as I said earlier, in some circumstances, specific coverages might be difficult to obtain depending on the contractor, its carrier, so on and so forth. The purpose of an exhibit is to raise those issues for discussion so that each of the parties, in this case, we'll talk about the fact the owner, understands what risk is being laid off by insurance, how it works, and what can't be laid off by insurance, or at least give the owner the opportunity to say, oh, you know what, I'll pay for that if that's the extra cost associated with making sure I have coverage in place for that kind of risk. The owner has choices. They can accept uninsured risk, they can pay added premiums for coverage, they can make changes needed to obtain the coverage, whether that means you change the contractor, you ask the contractor to change insurance carriers, etc. And the exhibit allows for all of those discussions based on the topics. So we talked about the owner's insurance, we talked about what the owner might want to require from the contractor, and all of that content is part of the insurance exhibits that we've developed. But I didn't want to leave the program without some discussion of insurance coverages that the owner might want of its design professionals, the architects and engineers on the project. Here again, you want to make sure that the coverages that are required of the architect are maintained until at least determination of the owner-architect agreement or owner-engineer agreement, when that design professional is going to stop doing work on the project. Now, design professionals have a tendency to run lean when it comes to insurance. They keep their overhead costs low, they keep their insurance coverages low oftentimes. So if any of the requirements that an owner feels are particularly necessary when it comes to professional liability insurance or other insurances for a project are in addition to the types and limits that I use the term architect here, but the design professional normally maintains, then the owner should be prepared to pay the difference in premium. Largely that works as well for the contractor. If you're going to require one of the parties to carry significantly more in coverage or to incur a specific project-specific premium increase, then it probably is in everybody's best interest if the owner agrees to absorb the premium. In addition, just like contractors, the design professionals should provide certificates of insurance to the owner that evidence their compliance with the contract-specific insurance requirements. So what is it that you should be thinking about? Here again, CGL for third-party claims for personal injury or property damage, auto liability coverage. You may want to allow them to get to the limits of those coverages with an umbrella or excess policy. Same considerations as before, including the exhaustion issue. Workers' compensation for those times that they're out on the site or otherwise moving about in their work. Employer's liability. And obviously, here for design professionals, professional liability coverage. You also want to make sure that where feasible, the owner is an additional insured. For example, on a CGL and auto liability. You're not going to be named as an additional insured on professional liability coverage. It's not the way those policies work, and they won't do that. And similar considerations, again, to what we had for the contractor. So that's the insurance coverages affiliated with the owner, the contractor, and design professionals. So I'm going to turn it over now to Mike, and he's going to talk about the value of bonds to the owner.
Thank you, Ken. So we're going to go for the rest of this program. We'll be covering our a brief discussion on bonds. We're going to start with the basics. What is a surety bond? It's a three-party agreement, typically where the surety is going to guarantee the performance of another party to a third party. So, unfortunately, bonds are written in a somewhat archaic language, even worse than insurance policies. So, when you see a bond, typically the surety will be referred to as the surety, and they will be guaranteeing the performance of the contractor. It could also be sureties will provide bonds to subcontractors, but for purposes of today, we'll mostly focus on the primary surety contractor-owner relationship. So the surety is guaranteeing the performance of the contractor, who will be referred to typically as the principal, and then the owner is going to be the obligee in a typical surety bond relationship. So, and as I said, contractors will often will require their subcontractors to provide bonds as well on projects. And in that instance, the contractor becomes the obligee and the subcontractor would be the principal, and the surety is still the surety. Now, and Ken has noted earlier that surety bonds are not insurance products, and I wanted to talk about that a little bit because the difference in nature of the product actually leads to one of the benefits of bonds, and that is because the difference I'm going to focus on is that for an insurance product, the insurance company knows that if there is a claim on the insurance policy, they're going to experience a loss, whatever the recoverable amount in the insurance policy is going to be. They're not going to recoup that from the contractor that they're insuring. That's different for a surety bond, as Ken pointed out. The surety bond, the contractor that the surety is backing up will have signed a general indemnity obligation back to the surety. So even if the surety has to pay out, they will be able to recoup those funds from a contractor. But ultimately, if the best way for a surety company to not incur a loss is for the contractor to perform its original obligations, because a surety's obligations under a surety bond won't kick in if the contractor adequately performs whatever obligation is being guaranteed, typically performance or payment to subs. So in order to protect itself, a surety is going to want to make sure that it's providing the bond to a contractor that is very likely to perform all of its obligations. And in the unlikely event that it is for some reason unable to, or fails to in this instance, perform its obligations, it wants to make sure that that contractor is going to have the financial wherewithal to back up the general indemnity obligations, so that ultimately the surety company doesn't have a loss. So that's different than how insurance companies deal with risk on insurance policies, where the exposure is spread out over thousands and thousands of projects, with each and premiums being paid for each of those policies. So the loss is spread out over all of those projects, but in a surety bond relationship, the risk is dealt with within that individual relationship. So that leads us to the first major benefit of a bond to an owner, and that's the pre-qualification process that the contractor has to go through just to get bonding capacity from a surety company. As I said, the best way for a surety company to protect itself is to make sure that a contractor is going to perform its obligations. And the only way to do that is to have an extensive pre-qualification process where the surety company is going to go through and do an in-depth analysis on the capabilities of a contractor. So when a contractor comes to a surety and says, I want to, I need bonding capacity, I need you to, I need to be able to issue bonds on projects, the surety is going to go through an extensive evaluation process. They're going to ask for things like the past 3 fiscal year financial statements and current copies of any loan agreements or lines of credit that it may have. You'll want to know current personal financial statements from the owners of the contractor to the extent that's relevant. Current work in progress, because a surety needs to know what overall capacity a contractor has to perform work. It's typically not doing one job at a time. It may have a number of jobs running concurrently. And so while any one contract may not be huge, if you have too many contracts that goes beyond the capacity of that contractor to perform, that puts the surety at risk. They're going to be asking for resumes of the owners and key employees of the company. They'll want letters of recommendations on past projects. They'll look for other statements regarding the qualifications of the company. Certainly, they're going to be looking for certificates of insurance, and they'll provide a questionnaire that they want the contractor to provide, in an interim financial statement, also pointing out any aging receivables or payables that they haven't collected on. All of this is going to factor into the surety's evaluation of the contractor. All getting to the ability and quality of this contractor to perform contracts within the bonding capacity that the surety will evaluate and provide. All of these things are things that an owner would certainly like to know about its contractor. So if a contractor is able to provide a bond, a performance bond on its project for you, you know that it's at least gone through this extensive pre-qualification process. And the surety is getting information that, as an owner, you could never get from a contractor to evaluate their ability. And then, as I said, the surety is going to require a general indemnity agreement from the contractor, so they have skin in the game to make sure that they're performing on this project, because they can't look at the surety bond as an ATM or a guarantee for performance, because the surety is going to come back on the contractor. So so that general indemnity agreement also plays into the value of a bond to an owner. Then there's the obvious benefit of the performance guarantee. The surety is backing up the contractor, at least to the extent of the penal sum of the bond, for the performance of the work, for the payment to the subs. There's also bid bonds and warranty bonds, which we'll talk about a little bit later. Also, and probably what's overlooked sometimes from an owner's perspective, is what surety companies refer to as silent services. These are benefits to the owner that oftentimes owners don't even know exist on a contract. on a construction project. Oftentimes, especially in the performance bond arena, the surety will intervene before there's an actual contractor default and provide assistance to the project, maybe allow the owner and the contractor to reach a conclusion that doesn't require a contractor default. It also may offer the principals, so that would be the contractor or sub, depending on the nature of the bond, other benefits that can ensure completion of the project. In some instances, the surety may even take control of the funds that are coming into the contractor, and maybe even provide additional capital to a struggling contractor so that they can avoid default. It may be that the contractor is high quality but has gotten a little bit in over their head and is in a tight spot and just needs to make it through another month or two to satisfy various obligations, and the contract, as far as you're concerned, can continue running smoothly despite the fact that the contractor went through a tight time. Surety will sometimes step in, again, because it doesn't want to have to perform under its surety bond. It wants the contractor to meet all of its obligations. Again, that's the best course of action for a surety. So these are all what they call silent services that a lot of times owners don't even know happen on a project. And lastly, all of these benefits that come with a bond on a construction project can be achieved at a relatively low cost when you look at the grand scheme of things. So in the construction world, there's pretty much four types of surety bonds. You've got bid bonds, performance bonds, payment bonds, and warranty bonds, which are sometimes called maintenance bonds as well. In a bid bond, you get it from a contractor when they bid the project, and it essentially protects the owner if, for some reason, the owner and that contractor are not able to ultimately sign the construction contract for whatever reason. If the owner has to move on to the next best bid, the surety bond will cover the difference in costs. So if you're incurring a higher contract sum because you couldn't reach an agreement with the original contractor you chose, the bid bond will cover that difference. Depending on how the bid bond is written, it may also cover any costs you've incurred in having to rebid the project, but that somewhat depends on the language of the bond. Performance bonds, essentially they are a guarantee of performance on the contract. So if the contractor it reaches a default point and that default can't be cured, and the owner is forced to essentially terminate the contractor, the surety will step in. It has a number of options on how it will actually perform, but it will make sure that the contractor's performance obligations are achieved. Again, subject though to the overall amount of the bond. There are a number of nuances to what options the surety has when it steps in, but in the interest of time, we won't go into those in this presentation. Payment bonds are there to ensure that the subs and suppliers and laborers on the project are paid what they're owed. And this is important for owners because if those subs and suppliers are not paid, their recourse is typically to lien the property. So that's, in this scenario, the owner has paid the contractor, and for whatever reason, the contractor isn't paying its subs and everyone. So the owner has met its obligation in paying what is owed, but for some reason, there's a problem downstream and the subs and everyone aren't getting paid. Well, the recourse is liening the owner's property. So a payment bond will step in to anyone that could lien the property and make sure, assuming that they meet all the notice requirements in the bond, they will step in and pay the claim to satisfy those subs and laborers and material suppliers so that they won't have to lien the property. So that's a big benefit to an owner, especially if you're looking to transfer ownership of the property when the project is over, because if it has liens on it, then it's hard to, there's a whole title problem. You won't be able to pass clean title until those liens are dealt with. So that can be a huge headache for owners. So the value of a payment bond should be pretty clear there. Warranty bonds, they are less prominent in the industry, but they exist, and they essentially cover warranty obligations that a contractor would have. They guarantee that the workmanship of the contractor will be of adequate quality. Typically, it's a short period of time after substantial completion, usually 1 to 2 years. They can be renewable for an additional fee. But getting into fee, as I said, bonds are really not all that expensive. Generally, they'll average out to around 1% of the contract amount. It depends, obviously. But for a performance bond, you're looking at a one-time premium that usually gets incorporated into the contract sum. You'll look at between maybe 0.5%, 3% of the contract amount. And the contractor will be the one obtaining the bond, but the owner is the one who will pay the bond. They're the ones ultimately who get the benefit of the bond. And that cost will be typically in the first pay request. Now, bid bonds, there's usually no fee associated with it. If a contractor has bonding capacity, a surety will typically just issue a bid bond as a matter of course for that contractor. And payment bonds are almost always issued in conjunction with a performance bond, so there's no additional charge there. So there's a number of benefits you can get from bonds, but they are at a relatively low cost when you think of the overall cost of a project. And typically, a performance bond is going to be for the full contract sum, and our suggestion would be that it always be for the full contract sum of the project. Material maintenance and warranty bonds are typically an additional fee, but it is our understanding that it's not that high as well. The AIA does publish some bond forms. We have a bid bond form as well as a payment performance bond. The A310 is our bid bond. The A312 is a combination bond. It's two separate bonds, but because they're always issued in conjunction with one another, they are a single form in our library, but it's two separate bonds in there, a payment and performance bond. The most recent versions are the 2010. We took a look at them leading into 2020 based on our typical 10-year revision cycle, but through our ongoing involvement with the various surety associations and other stakeholders in the industry, the word was there really was no need to update them. So they will maintain their 2010 date. But in developing those documents, we worked very closely with all the relevant stakeholders, owners groups, contractors, subcontractors, design professionals, with significant involvement from the two major surety company associations, NASBP, which is National Association of Surety Bond Producers, and SFAA, the Surety and Fidelity Association of America. We worked very closely with them. There's a commentary that goes along with the A312. They were instrumental in helping us draft that, and so we much appreciate their involvement. And largely, I think because of their involvement, our bond forms are widely used and accepted by surety companies. Many of them, through their association with these two surety groups, have the right to essentially reproduce our bond language on their own letterhead. So you will see the AIA bond forms either in title or in text from surety companies throughout the industry. If we have time, we will take some questions here at the end, but I just wanted to thank everybody for their time. I'll leave up on the screen here some contact information and resources if you're interested in following up with anything. We have a document content helpline there. You'll see that. If you are a user of our ACD outline services, we have a technical support team as well. I'm going to encourage you to check out our Contract Documents Learn page. There's a lot of information about all of our documents. And of course, if you're interested in getting a sample of the insurance and bonds exhibit, we have a link there where you could download a free sample. I think we're actually close to the end of time, but I'll turn it over to Hafsi and she can wrap up this program for us.
Well, thank you very much, Mike and Ken. That was a very informative session. We are out of time, but I am just going to go through a few questions. So just give me one moment. I saw a few questions coming in through the chat, so let us answer as much as we possibly can. Does AIA have any documents that deal or talk about maintenance bonds or maintenance clauses for owners after consumption?
We're working on developing one right now. It's not been published yet. Our hope is to have it published within the next calendar year. We are working right now with the two surety associations to make sure that we have the language where that will be appropriate for use by the sureties in the industry. So not yet, but we expect to have that out in the next calendar year.
What happens if the owner wants to purchase the builder's risk?
Well, I mean, it is all part of the contract negotiation, but owners generally can get the builder's risk. Our exhibit starts from the assumption that the owner will get the builder's risk, but it's a discussion that should be had with the contractor, because sometimes the contractor can get it cheaper, and so you should have that conversation if you want. But we start from the assumption that the owner is going to get the builder's risk.
Okay, so here's a question. I think there might be a typo in it, but what does the contractor must maintain insurance until the period for correction? Does that include subs too?
Well, it will depend on what, if anything, the prime contract says about required insurance for subcontractors. I think as a practical matter, oftentimes contractors say, hey, look, if I'm going to be on the hook for this, you are too. And so they would probably want to flow down that obligation to the subs. I think that if you have a broad flow down provision, one could even argue that to the extent that the sub is required to maintain insurance coverage for its portion of work similar to the contractor, that the obligation to keep it in place stays. This is a difficult one, though, in that you may have an early completing sub. So you're going to have to, probably try to figure out how that will play out with an early completing sub if you've got a long tail on the project.
Car insurance owned or used for that particular job site, how does it get verified?
I think you want two things. As an owner, you want to get the certificates of insurance, and you want to deal with your insurance advisor. Let them parse through what the certificate of insurance says and whether or not they think that the contractors met the obligation for the scope of coverage. It's going to depend on the way the policy is written. It might depend on the certificate. Those are all good questions for folks that deal with this on a daily basis, your insurance advisor.
Okay, and with that, there were a few other questions, but we're going to go ahead and end the session. You will receive the PowerPoint and the recording of today's session. Please feel free to contact us with any additional questions that we didn't get to answer today. With that, I want to thank Ken and Mike for taking the time to present today, and all of you for taking the time to listen. We hope you found this webinar helpful. Thank you very much and have a great afternoon.